those that have not been to a Noble Fireside Chat, this is really what it is, and we like to think of this as a conversation that we would normally have. And Chris, Hilda, Tony, and I are part of a group, IRAFAC. We spend a lot of time together with other leaders in our industry and investment banking, et cetera, to talk about the world, what's happening, what's our thesis, what's the data say, what's the research say. So what we thought would be a good idea is to kind of give you a little bit of an introspective in terms of those conversations, how it works. I think you're tired of listening to me and to our team about economics and data and research through our lens, but from a global standpoint, Tony and Chris represent almost 50 brands, but equally important across the world, well over 100 countries each, but also 300 million members combined between Hilton Honors and Marriott Bonvoy. So there's a lot of guest data that takes place there. Hilda is just a burst of energy and fire across the globe, all things relative to real estate, all segments, capital markets, debt placement, equity placements, as well as in transaction and advisory. She's got an amazing team. You've also seen her at Noble Fireside Chats before. She's an important part of how we think about the transaction market, valuations, opportunities. But most importantly, let me just say something about these three people that are there, and I probably don't say this enough. The value that you provide to me personally, and across all boundaries. As friends, we've vacationed and we've traveled together and we've done really great things. The more often we get to spend time with each other, the more full my heart is, and the more I feel that I'm just better at everything. And I know our team feels the exact same way in terms of the interaction and engagement that we have with your teams.
We're both getting ready to report earnings, so neither of us, I'm sure, are going to talk specifically about our own earnings, because we'll do that in the next couple weeks. But if you look at the industry data, you can see it, and it speaks pretty clearly that basically all segments are very strong. Leisure, which has been off the charts since COVID recovery started, you would typically see fall off pretty materially in the fall season. People are off vacation, kids are back in school, and while there's been some decline in leisure, it remains at significantly elevated levels to what we would have seen pre-pandemic. And then business transient, which normally would start, picking up quite heavily in the fall. And of course, during COVID, was truncated to a large degree, is recovering quite nicely as well. It's been bifurcated as between like SMB, small, medium businesses, and the big corporates. The outside world looks at business transient generally through the lens of big corporates. But the vast majority of all of our business is small and medium-sized businesses, and they're back traveling, not just at the levels they were traveling pre-COVID, but beyond that. The big corporates are getting back there. I mean, we've started to see just in the last month that big corporate forward bookings are above 19 levels. Consumed revenue for big corporates is still not there, but the net story of business transient is recovering, and then group meetings and events is always on a lag because it takes time to plan all these things, particularly the really big groups, the association groups. Those are, those can be months and in many cases years in planning. So it's from a consumed revenue point of view, it's still a pretty decent amount below prior peaks. From the standpoint of forward bookings, it is now eclipsing that. So you can sort of it's pretty easy to prognosticate that you are cresting over 2019 prior high water marks in all segments. I think if you look at industry data, third quarter, everybody will report that they eclipsed 2019 levels. So, and looking at booking data, looking at it daily, across all those segments, it's hard to find. Kevin knows because I badger him and our commercial teams every Monday morning, and I did it this Monday morning. Are you seeing any cracks, any signs? And we're just not seeing it. So Last thing I'll say, the elephant in the room is what you talked about, what's going on in the macro. We obviously will all be impacted in the industry by the macro. And it's hard to know. There's a great deal of uncertainty about what will go on. I think there is a reasonable likelihood that we will go into some form of recession. Hard to know how long, how deep. And the thing that we have in our industry, getting back to the segments, is got a lot of wind in our sails. Consumers still have close to $2 trillion in the U.S. incremental in their pocket that they didn't have pre-COVID. So while they may not want to spend it all, they have it and they will spend it, and they've had a propensity to want to party like rock stars on weekends. I mean, I look at our data on the weekends, it's crazy. Like Saturday nights, we're running in 5,000 hotels in the U.S. over 90% occupancy. It's like, I've never seen it. So people are out there. They want to do it. And the business transient we talked about, meetings and events, those things are all, recovering, and it's a lot of pent-up demand. The world is opening up, and international. We haven't had international. So layer that on top, which is coming back, and then put on top of the whole, puzzle, a shift that was happening for a long time pre-COVID that got reversed in terms of spending patterns. Secularly, we were shifting to people spending more money on experiences than things. We went and flipped it radically to things and not experiences because nobody could move. And now if you look at how people are spending money, it's shifting pretty radically back. The proportion, they may have less money to spend in a slowing economy, but they're going to spend a lot more of it on the things that are good for our business. So it's a long-winded way of saying, it makes me pretty optimistic that for now, and I think for a pretty decent period of time, there's more wind in our sail than the wind that is obviously in our face, which is slowing macro conditions here and around the world.
As you might expect, given the similarities of our businesses, we see a lot of the same things. I might just build on that with a couple points. I think number one, the most remarkable trend we've seen in this recovery is the speed and the steepness of the recovery and pricing power. If you look at the last two big shocks to travel and tourism, 9/11 and the Great Recession, it took between 4 and 5 years for the industry to see pricing power recover. In less than 2 years, we were at record pricing power. Now, that creates some challenges because no guest ever wants to pay higher prices. They understand supply and demand, they're willing to, but that comes with a service expectation. And so some of the labor challenges we see in the industry create a little bit of a riddle there. I think secondly, I would point out group, and Chris referenced this. Early in the recovery, many experts said leisure will lead the recovery, then business transient, and eventually group will come limping across the threshold. In many ways, those last two segments have inverted. The strength of group has been remarkable. And to Chris's point, we are susceptible to economic trends. We work in a cyclical industry. One of the things that makes it hard, we all get the same questions. In the face of the inflationary environment and rising interest rates and political instability around the world, aren't you worried? I think the answer that we all give is, of course, we're monitoring, but we just don't see it in the data. The caveat I would give you is, with the exception of group, for transient, the booking window is as short as we've ever seen. And so while today I didn't see it in the data, we've obviously got to be vigilant and look and see how these economic headwinds start to impact our business.
We've got to deliver, particularly in a world where we're charging the highest rates we've ever charged. In many cases, rates are up in points of time 20+%, and yet customers aren't getting the experience. So we have to not just get the labor in, but be able to deliver on the experience. The other part of the experience outside of the labor and the service is the product. And here's the real hard truth. You're looking at systems, big systems like the ones represented in Tony's enterprise and ours and every other one, where you're going to have gone for 3 to 5 years when you get down to it, and you get geared back up without major investment in properties. And so if somebody had just done the work, that's probably not that big a deal, because that would be, sort of within the normal constraints of of investing on a cycle, but a lot of people hadn't. And so you have service issues compounded with product issues. So as brand company, I'll speak for this brand company, we obviously have to work with owners and be thoughtful. But in the end, we're not doing our system any good, and thus our broad ownership community any good if we don't deliver for customers on product and service. And so we have to, by definition, be much more disciplined and committed to working with the owner community to get the investment get back on the horse, so to speak, on reinvestment. And that, that does, in a world where owners haven't fully recovered and many borrowed a lot of money to get through, that does put some pressure in the system. Unfortunately, if we don't do it, it puts even more pressure in the system, because in the end, if you don't have product and service, you're going to dump share, and owners are going to lose or are going to take an asset where maybe they're struggling, and they're most definitely going to lose the asset. And so, from the standpoint, Amit and I have talked about this, not necessarily in the lead up to tonight, but just over time. But what will happen, and hopefully it won't be that painful, you're going to see a lot more turnover and a lot more opportunity. Why? People they're now performing, the bulk of our system actually is making more money than they've ever made. Not everybody, but the majority of our hotels are more profitable than they've ever been. But they borrowed a lot of money to sort of get through it potentially. They have a lot of deferred CapEx, and at some point they got to put the money in. They got a massive wave of refinancing that many of that's going to be flowing through. And by the way, those that didn't lock in and have that problem are on floating rate debt that has been skyrocketing as rates have gone up. And so you have all of these things converging that, to me, over the next year or two, are going to create a lot more stimulus for transactional activity. Going forward, I think we'll see a lot greater change of ownership, but not because they're losing them, because they're going to say, if I own 5 or 6 hotels, I'm going to sell 2 or 3, and keep the others, because I want to reinvest in the others, and I need to get my equity out of these. So I do think you're going to see a lot more pressure, but that there'll be, opportunities, because there is capital like Noble on the sidelines to help make that happen.
So with those two caveats, thinking about the challenge with product and CapEx reserves that you've allowed and others have allowed owners in which to utilize, and the challenge relative to just the operating model, Gilda, take us through your house view of just how Chris mentioned kind of over the next 2 years. Help us think about that that situation and how do you think it manifests?
So just from a numbers perspective, quick KPIs for this year, the performance is amazing. RevPAR year to date for select service, we're at 107% of 2019 levels. If you look at the urban RevPAR recovery, which has been the laggard, and they both mentioned we're finally seeing that return of the business travel, the international travel coming back to the major urban gateway cities, we're finally seeing that recovery. Well, that RevPAR is now at 95% of 2019 levels. On the supply side, this for me is a very interesting stat. There's only been 91 hotels that have opened so far this year. Just to put it into perspective, the average year is 500. 500 hotels. You get a year like 2016, 1,000 hotels had opened by now. So now you have this perfect dynamic of supply, demand. Look at room revenue, $81 billion so far. The highest ever tracked in history. What is that doing? Obviously fueling a very insatiable investor demand for select service, which is now a fully institutionalized class. As you all heard, we have a super strong U.S. consumer base, so check in terms of fundamentals. But now we have the trifecta brewing, and that's the clouds that we see in the horizon. We talked about CapEx. We talk about the fact that there aren't very many FF&E reserves at the moment, because those have been used to make payroll and come up with other obligations. Also, one should know that CapEx, we got to think about inflationary pressures on CapEx budgets going forward. We have an amazing amount of loan maturities coming up. And obviously the dynamics right now in the debt markets make refinancings also very tricky, or even loan extensions. And then we have fund life issues. And if you remember what I said right now, This is an institutionalized asset class. This is great food for private equity. Private equity on average maybe invest 5-7 years, maybe some 10. All these assets are now coming out in the cycle. So why is this sector so interesting? It is, select service, the best performing commercial real estate asset class, and I'm not saying it because Mitt told me to say it, but if you look at premiums for 2007, on average, annual select service yields compared to industrial, multifamily, retail office, they're usually about 160 to 260 points higher in any one year. You'll look at the performance just from an occupancy and, let's say, a rents or ADR perspective. If we compare it to the next best asset class, that being industrial, occupancy for us in the last cycle, measured as 2010 to 2019, we are 61 basis points better than industrial from an occupancy perspective, from a utilization perspective. If you look at our rents or ADRs, which we're obviously able to set up daily, the CAGR during the last cycle was 8.6%, which is a 470 basis point premium over the rents that you can get in industrial. From talking about the elephant in the room, inflation, historically for the last 20 years, select service hotels have traded at a premium of 500 basis points above inflation. So let's talk about the one leg of the triangle, hopefully not the triangle of doom, but we have $7 billion of securitized select service maturities coming up in the next 16 months. There's a further $6 billion of select service CMBS maturities coming up in 2024. If you look at it by region, most of these maturities are in markets that maybe haven't fully recovered. But for those who are looking for premium select service opportunities and higher growth markets, if you combine both the Southeast and South Central, we're at 36% of those maturities are backed by assets that are located in those prime regions of the U.S. We talked about this pipeline that is coming due, so the other leg of the triangle. If we argue or take as a fact that the average fund life is 5 to 7 years, all we got to do is look back at 2015, 2017. Those were the peak transaction years. Those assets are coming due. And then one must further think about the fact that those assets that were acquired in 12, 13, 14, they did not trade during the pandemic because we were in this synthetic, let's hold back type of place. So again, that also needs to be added to this wave of product that is going to hit the market. Look at the amount of debt originations that happened between 2017 and 2019, $120 billion. That compares to $85 billion of trade. So there were more originations than trades. That means there were more refinancings. Those refinancings are now back up to refinancings. Well, we all know in the current environment, they're not going to meet those debt extension tests. And what we've been spending quite a bit of time at JLL talking about it with Kevin is the purchase of those new interest rate caps. It's prohibitive. It's prohibitive. So again, that is also coming in the churn. And then lastly, what I'm actually tracking is what happens in the fourth quarter. And when we supplied our global outlook at the end of last year, beginning of this year, everything pointed out to us having a monster year, especially in the US, with total transaction volume exceeding that $46 billion. I'm not sure what happens in Q4 for the following reasons. One, we've had anecdotal evidence of investors saying, at JLL, maybe we take a step back and we figure out what happens in Q1. But really, it's more, one, how do you underwrite a pro forma in an inflationary environment? How do we think about ADR? Yes, there's a lot of savings. There's a lot of money, very cheap money that was printing that still needs to go into the hotel system. So, okay, check. Let's see for those hotels that are not yet fully renovated. On the operating expense side or revenue side, how do we factor inflation? On the CapEx side, how do we factor inflation as well? So that's one question. The other bit is we're approaching budgeting season, so I'd be very keen to hear how you both are thinking about budgets for 2023. So that's interesting. That we need to wait. Then you have obviously quite a bit of interest rate volatility. So how do you not only underwrite acquisition financing, but also a refinancing in 3 years' time? We have our house view, but we may be way off or not. And then there's the whole foreign investor perspective and the investors that are literally out on the sidelines in terms of, how do they think about the U.S. from an overall macro perspective. The reality is most investors have told us they will continue to increase their allocations towards the U.S. given the strength of the consumer and of their overall economy. But the reality is that that money may take a little bit of time for it to come into the system, and then we're talking about foreign exchange issues that make the dollar really expensive. So, with that, all in all, just to say that hopefully there's some bonanza coming in terms of acquisitions. We're going to have to figure out, which assets are the winners, which ones are not. We have, new consumer trends or consumer demand. So how many buildings or new hotels adapt to that next gen of travel. But I would say this is probably, I think, the consensus that we're getting across the board globally, and not just the U.S., is that we're probably about to enter the greatest acquisition opportunity of our lifetime.